I'm here today with Sadia Sheikh, and Sadia, you're the head of B2B economics here at Experian. So what we're going to talk about today is the housing market, a real hot topic that we're seeing at the moment. So it seems that with new data coming out shows that after we went to a complete standstill in April, house prices and activity, since we've come out of lockdown, are now starting to pick up. But are we seeing a rebound in the housing market?
So yes, you're right that the new data that's come out both on the house price front and on the activity front, we're seeing an improvement across the board. For example, if we look at the key house price indices that we usually monitor, Halifax, Nationwide, Rightmove, all have recorded a positive change in house prices in July. And really what that means is that we've seen positive month-on-month growth, and that annual house price growth has once again tipped into positive territory. So that's all very encouraging. Equally on the activity front, if we look at the RIC survey, which is the standard survey to use, we've seen high buyer demand, we've seen more agreed sales, we've seen more new instructions on the market. If you look at official data such as Bank of England mortgage lending, HMRC transactions, across the board, we have seen an improvement in July. So that's very encouraging, very positive. However, the caveats are really, it's important to remember, first of all, that we're coming back from an unprecedented level of weakness. So yes, we have had, let's say, mortgages rebound to 40,000 from 9,000, but you've got to see where we're coming from. The 6-month average actually was 60,000 per month. So we're coming back from extreme levels of weakness. And I think the second thing to remember is that all of this activity, even if it's lackluster, is underpinned by huge amounts of government support. So, for example, we've got, if you talk about the two big ones, the coronavirus job retention scheme, or the stamp, if you focus on the housing market, the stamp duty holiday for houses under $500,000. Certainly, they're having a positive impact on the market, but I think the real moment of truth will come when these are unwound. So, yes, we've had an improvement compared to the previous 3 months, but I would say I would be cautious to call it a rebound at this particular stage.
So what is our outlook for the house market prices, where they're going? Do you think we'll see any positive impacts of pent-up demand that we're going to be expecting now after the December general election? So we were expecting some demand. Are we going to be seeing that now?
So in terms of our outlook, I think it's safe to say it's very subdued. The reason is, as I just mentioned, that any recovery that we're seeing at the moment is underpinned by a huge amount of government support. And as I said, the moment of truth will come when that's unwound. So for example, when we see the coronavirus job retention scheme scaled back in October, the general consensus is that is that point when we will see a spike in unemployment. And that essentially what that means is that the labour market will be very weak. We'll have pressure on incomes. Generally, confidence in buyers will be quite low. And these really aren't the conditions where you would expect buyer demand to thrive. Now, you're absolutely right that post-December, there was expected to be a bit of a rebound, or what people were calling the Boris bounce in January. And there were some early indications of that. But obviously, COVID-19 sort of put an end to that, or in some ways perhaps postponed it to, maybe when the market was unlocked. And there might be some elements of that coming through, but the nature of these bounces are that they are temporary. And eventually what does override everything are economic fundamentals. And at the moment, economic fundamentals are quite weak, particularly looking at the perspective of the housing market. The labour market is critical, and that really is not in a very strong shape at the moment. And aside from the fact that, there might be an X number of people who are made redundant or who lose their jobs in October, even if you have your job in October, what you would be looking at is the general economic situation before you commit to a big ticket item purchase, and housing definitely comes under that. So certainly what we think is, because of weak economic fundamentals and generally weak economic or buyer confidence, we would expect the pressure on house prices to be downwards. However, I think I do need to qualify that. We're not expecting by any means a house price crash, but what we really are saying is we are expecting a volatile movement of house prices around a generally flat and unimpressive lackluster trend. And that's no different from what we've actually been seeing over the last 3 to 4 years now. So what we're expecting is more a continuation of the lackluster trend that we've seen so far.
Are we going to see any regional differences in performance? So will there be stronger versus weaker performers, or are regional patterns expected to follow similar trends?
I think in terms of the initial impact, you'd be hard pressed to find any area where you would say, well, actually that was sort of safe from the impact of COVID. I think we've seen declines in performance, economic performance, weakness in housing market activity across the board. So I think it's safe to say that even going forward, there will be downward pressure across all the regions. The one caveat I would put is that looking ahead, there might be some supportive measures supporting London's or upside risks around London's housing market, simply because of its status as a safe haven for overseas investors. So typically, some of the circumstances or conditions that we're seeing at the moment would be quite appealing to overseas investors. First of all, you've got sterling much weaker than it was historically. We've had 3 or 4 years of sustained decline in prime central London property prices anyway, just because of a weaker economy. So you certainly might be at that point where overseas investors are thinking, well, maybe the declines have gone out and it's a good time to purchase. And finally, given the unrest or the sort of difficult economic conditions we're seeing across the board, we would be likely to think that there could be some good bargains to be had. So certainly all of these elements would attract overseas investors. So that could potentially be an upside for buyer demand in central London. But otherwise, we do expect general weakness in all other regions.
And what would you see as being the key risks that could potentially derail the housing market recovery?
I think at this particular stage, any risks would really come from the economic side or the labour market side. So when we talk about the economic recovery, all the discussion I've had so far is based on the assumption of what we call a delayed V-economic recovery. And that comes with some very strong assumptions. Namely, we're expecting economic activity to rebound this quarter, or at least start picking up this quarter and then become stronger next quarter. We're expecting there to be no second wave. We're expecting that the government supportive measures will do their job. Now, if any of these conditions are not met, that's certainly a downside risk that could derail the very fragile recovery we're already seeing. I mean, if you look at, let's say, the government supportive measures, the idea is that once they're removed, it's going to be business as usual. But that can be challenged and questioned, because if we look around, the government is having to actually step in and encourage people to spend. The eat out to help out, and encouraging office workers to head back to their offices. So certainly there are conditions where we might suspect that this might not just be back to business as usual in Q3 and Q4. And equally, in terms of the second wave, we're already beginning to see some localized lockdowns across the country. So can we say that there will be no second wave? I mean, it's not a done deal, is it? So certainly all of these things are downside risks to the housing market recovery. And last but not least, I think we tend to forget in these times, we do have Brexit looming at the end of the year. And if we do have, say, a no-deal Brexit, certainly what we would have is a further knock on investor confidence, buyer confidence in an already fragile economy. So I think from my perspective, the key message to take away really is that, yes, we have had some positive indicators coming out in recent months, in recent weeks. And that's very encouraging, but equally this is not really the time to get complacent, because there are some significant challenges that lie ahead, and that's something that we monitor on a day-to-day basis and keep an eye on.
Well, that was really interesting, and as you just say, we're continually monitoring, aren't we? And these trends are available in the latest housing report as well, that obviously we can make available. Yeah. So that was really helpful. Yeah. Thank you for your time.